Oh, I think we're live. I'm just going to do a quick check. And if we are live, everyone, we'll be kicking off in just about 1 minute here. We're just, yep, and awesome. It does look like we are live with my good friend Eric Chevrette, live from the Montreal airport as we balance webinars and traveling and back to the real world. But we're excited to have a really good session for you today. And in fact, it looks like we already have our first question coming in the Q&A before we even kick live, Eric.
Wow.
Yeah, so they want to know if the beneficiary of an insurance payout needs to own shares in the corporation, which we'll probably be covering some of that. I guess a lot depends on what kind of insurance policy they have, right?
Yeah, it's a little bit more complex than that, but we will probably cover that. And if not, bring back your question.
Yes, exactly. Yeah, we'll definitely be coming back. I won't close out that question, so we'll have it in the queue. And I can see we've got quite a few attendees logging in, and we've just got about 30 seconds here, and we've still got people joining us on the live event. If you're joining us on one of our social media channels, watching us live, you can post your questions into that platform, and one of my colleagues will be sure to relay that over to our live session here in Zoom. Of course, if you're here with us on Zoom, we do ask that you use the Q&A feature in Zoom. We'll be looking at that. First, we will check the chat before we wrap up and close out the session, which we will keep firm to the 1:30 stop, if not earlier, because Eric has a flight to catch at 2:10, and he's doing this live from the airport for us. And I'm thrilled to have Eric, who is our partner from IT360, here to share with you all this amazing value about the intricacies of leveraging insurance products as a strategic tool for asset transfer. And this session is designed for individuals and business owners who are seeking to optimize their wealth management by moving assets from their corporate holdings to their personal wealth in a sort of fiscally efficient manner. So that's the topic for today's session. And why don't we start by, again, welcoming Eric for joining us. So thank you, Eric, for joining us, despite your busy schedule as you're flying around the world. So thank you for joining us. How are you doing today?
I'm doing great. Thank you for having me, Andrew.
And I'm excited to talk about this because you and I certainly know the benefits of using life insurance as a strategy for asset transfer because of the capital dividend account and the benefits that a corporate life insurance policy can bring to the individual. But I don't want to steal your thunder because I know you had lots of things to talk about and to even show us some specific examples because you've been with us on some past webinars and people have always been really intrigued by the way that we can leverage insurance strategies for corporate transfers of assets and wealth. And the big question everyone came back to us with, well, can you show us this in some real world examples, which obviously are going to vary greatly. So we've got some sort of sample data, for a lack of a better word,
Yes.
to sort of walk people through the examples. But I guess where would you like to start when it comes to leveraging these insurance products as a strategic tool for asset transfer?
Basically, it's sad even today that it's such a well-kept secret. I mean, people dealing with incorporated people are aware of these strategies for a long, long, long time. But what I realized a long time ago, probably as you, is that the community of independent contractors, for some reason, are not aware of these strategies that the regular folks in the incorporated world use. So what we're going to discuss today is used by incorporated doctors, dentists, huge business owners, and it has a very good tax treatment.
Mm-hmm.
So what I will do is when we work with clients, we work on the personal level and the corporate level. And the main goal is what is the cost of that dollar in your pocket by the time you pay all these tax gates. Okay,
Hmm.
so the money is in the corp. It's great. You grow the money, but one day or another, you will need that money to retire. And one day or another, that's sad, but you're gonna die, and the government will always be there to grab his share.
Yeah.
So I will show you two strategies today. One is very, very simple, very powerful. We use critical illness strategy, and the life insurance one is simple, but has multiple ways of using it. So I will
Hmm.
spend a little bit more time on the life insurance side because not that for me it's more important, but it's a little bit more complex and has more options on how you
Right.
can use it and use the money. Okay.
Hmm. Yeah, and this sounds excellent. I'm really excited to hear about this one. One thing I want to just maybe take a step back and explain for those people who may not be familiar with it is that if you have a corporation and you built up retained earnings inside this corporation, and you are the last of your spouses to pass away, and you're transferring that asset, which is your corporation, onto the next generation, that the estate would be taxed normally on basically what are the retained earnings of the corporation. Now, there are some strategies with rollovers and estate freezes for deferring that tax, so to speak. But effectively, the long and short of it is the estate could be potentially taxed on the entire value of those retained earnings. And
Definitely.
one of the things that some of these insurance policies do is allow us to, in some situations, completely eliminate that tax because that's coming into the corporation through this special capital dividend account, which can flow through to the shareholders, which would be the estate, tax free, which can be some significant benefits. Now, that may not be the entire value of the corporation. There could be other things, but I guess that's where we're going to talk about some of the other tools and vehicles that we're going to use. But I guess so. The two main products that you're really recommending here, Eric, would really be the critical illness and life insurance, correct?
Exactly. Yeah.
Yeah.
So if you want, I mean, I have three main documents that I want to share with the group today. The first one will be about how we use critical illness split dollar concept in a corporation environment. Then
Hmm.
I will show different aspects of life insurance
Yeah.
and how we present that in a financial plan. So basically, I mentioned that at the my previous appearance at your webinar or session is we put together a tool, Andrew, that didn't exist on the market to take into consideration personal and corporate and account for the real tax level.
Hmm.
Capital gains are taxed differently, dividend are taxed differently, interest rate are taxed differently, and there was no tool that really existed on the market, so we created it 15 years ago. Why is it important? It's not to pat ourselves in the back, and say, oh, we created a tool. It's more because when we work with a client, all the clients have done some stuff that were very good. So
Hmm.
we import what they've done and we modelize this to retirement and till they die. And then the software will optimize the situation, making recommendation like if you do this, this, and that, this is now the new modelization at retirement and when you die. And
Right.
this is what I will show a regular plan that we've done for an independent consultant. And we always work with that kind of tool to optimize the situation. So if you want, I can start by the critical illness, or maybe you have another
I think
question
let's
or
start with the critical illness because I think there's
perfect.
also there's real benefits to the critical illness as if something actually were to happen to you and you were to get critically ill.
That's it. So everybody sees my screen.
Yep.
So the critical illness split dollar has been around for almost 24 or 25 years. And CRA say that basically any business owners can take a critical illness coverage with an insurable interest on him, on his wife, on kids, even parents, okay? Because there's a concept in insurance that would there be a commercial effect if the guy get critically ill, or if his wife, even if she's not working in the company, got critically ill? The answer is yes, because even if she's not working in the company, he would probably have to take time off from his contract, bringing her to chemotherapy or whatever, you know. So the concept is very simple. The company with retained earnings pays the full amount. So you see here the $5,000 plus the $2,400. So let's say the company pays $7,000, but we will attribute on a yearly basis like a dividend. So if money is in the court and then I transfer the money to my hand, I will have to pay 100% of the tax due on that dividend transfer. But here, we pay 100% with the company. We attribute a dividend in that case of 1/3 of the money. And three things can happen during the course of the contract. Either we are critically ill, and that guy would receive $500,000 in the company tax-free, and the contract is finished. So you invest 7,000, 7,000, 7,000, and you get sick. You receive $500,000 and the contract is over, okay? If you die, they will pay the biggest of the two amounts, which is 25% of the critical illness payout, or the premium paid to this time back to the company. But why we use this and why is it so powerful? You see the kind of rate of return that we're achieving with this is because of the tax minimization strategy behind this concept. We transfer money by only paying 1/3 of the tax due. So if we don't get sick, so we stay healthy, the money that our corporation paid to the third party, the insurance company, will get back to the independent contractor tax-free at the end of the term, okay? So basically, you cannot lose. Either you're sick or you die prematurely, and we're not happy, but you receive a huge chunk of money. And if you're like most Canadian and you don't get sick or die prematurely, but you didn't do this in vain. You did that to pay 2/3 less tax on the transfer of wealth, because the money will get back to you personally with no additional tax to be paid. So this strategy is very, very, very powerful. Okay.
So this is almost a hybrid between critical illness and life insurance. Is that a fair assumption?
But we cannot remove the life insurance that is associated with that contract. So it doesn't exist on the market. An insurance company that has a critical illness without some kind of payout on life insurance. But I wouldn't recommend to do this concept to cover the need of a life insurance coverage. It has some life insurance concept into it, but not
that's not
like
its primary benefit. It really is critical illness as the primary benefit. The life insurance really is there just as a way to get back, effectively get back what your costs are going into it. Correct? Is that a safe way to put it?
Yeah, in a sense, you know. So here, basically, the rate of return is made because we pay only 1/3 of the taxes due on the transfer of wealth from corp to personal. And if we get sick, but you didn't make a great deal, what you do is they return the money back to the corporation, and it's pretty much a wash. So what you lose is you lose the use of your money in case of a premature death.
Yeah.
But if
So
you
you've
look
got
at it,
the benefit of being covered if anything were to happen to you.
yeah,
And at the end, as long as you're getting this, as long as you don't stop paying your critical illness throughout the thing and you keep it right till the end, you're going to get the benefit through the transfer of wealth, through the tax savings and the transfer of the
exactly,
wealth to make
exactly.
up for the cost that you had, during the life. And in addition to that, if God forbid anything were to happen, you end up even further ahead.
You make $500,000 on a
Yeah.
$7,000 annual investment. So not that I bet on you getting sick, but you're sick, it pays. You're not sick, you save 2/3 of taxes.
Right.
So we call this a tax minimization strategy where the rate of return is accomplished because of the tax minimization. Okay.
Yeah.
Okay.
And also, speaking of our client base and the IT contractors, where we always talk about PSB risk and PSC, we are usually looking at E&O as the way to demonstrate that there's risk for profit or loss from an errors and omissions standpoint. But
Yeah.
here's another way to demonstrate again that there's a risk for profit or loss that, hey, God forbid something were to happen to me, I would no longer be able to generate income in my corporation. There's another risk for profit or loss, which
Yeah.
goes to help protect
Yeah.
from a personal service business risk
Yeah.
standpoint as well.
And CRA is always great in the way they write this in their CRA guidelines, but you almost need to read between the line, and the people we work with, either in Montreal or in Toronto, the tax expert basically, when they look at CRA guidelines, they say that everything that you can do to prove the auditor that you covered your ass in case of a loss and profit and loss protection. Yes, E&O is great, general liability, wonderful, but all these insurances that we talk about, disability, critical, life insurance,
Right.
are also accounted for during the test about the independence or misclassification of an independent contractor, so it's
Because by definition, insurance is to protect against risks, right? By definition of it.
That's it,
Um,
exactly.
Now, we do already have some questions that have come in from the community. And so the first question, we still have that question from the beneficiary of insurance, which we maybe should talk about from the perspective of critical illness, as far as whether the beneficiaries need to be shareholders, need to be the corporation or cannot be shareholders.
Yeah,
But we
if you
also have
can,
another,
Andrew, if you can, ask all the question away about critical illness. After I will do the life insurance portion. And if I didn't cover the questions, then we will ask the life insurance question, if you're okay with that.
Yeah, because we do have another question in here about just the insurance in general, which I assume that they're referring to the critical illness. Is they're asking if it's possible to increase or decrease the insurance amount during the insurance term.
You cannot decrease without penalty. Okay, so basically it's like I see that as a pension plan. Okay,
Right.
so when you work as an employee at the government is not asking you every year, hey, how much money do you want to put in your pension plan this year? They take a percentage of your salary and they force you to save into that plan. This is a little bit the way it is. From the beginning how much money is optimal for your situation to minimize taxation, how much money you need to put in the contract.
Right.
You need to bring the contract to term. If you don't bring the contract to term, there's ways to manage it on the exit strategy, but you cannot say, oh, okay, this year I'll put 10 grand, the following year I'll put 5 grand, or you know what, I mean, I will start with 50 grand and I finish with 5 grand. You cannot do that. So
Right.
it's a little bit more rigid than other strategy, but the flip side is, but what are the returns? I mean, what
Right.
kind of nothing's perfect in life, I mean, yes, there's some rigidity into this strategy, but my God, is there a great tax saving associated to it,
Yeah, there are big benefits, but it's something you are committing to in order to get those benefits.
Mhm.
Now,
Yeah.
there are usually some backdoors that, like you said, have some costs associated with them. With these critical illness, are there any cash surrender values that there is a backdoor? There's no cash surrender
No,
value at all on critical
no,
illness.
no. That's why it's very simple. It's you pay with your corporate dollar.
Hmm.
We attribute in the form of a dividend a percentage of the premium that was paid by the corp, where that line is not drawn by me, the line is drawn by the insurance companies.
Right.
So let's say in a very quick example, you invest $45,000 a year in a concept like this.
Hmm.
But depending on your age, I took the example of a 38 or 39-year-old male. That guy with you, Andrew, would have to pay tax not on the full $45,000 that's invested and leave the company to go to the third party. We will only tax him on 15,000 yearly.
Right.
So he will pay $5,000 of tax yearly, but will get back at the end almost $700,000 with no additional tax to be paid. So if I put that in a financial calculator and I say, what kind of rate of return this strategy represent? Then depending on the age, depending on the cost of living, it will be between 8 and 12% rate of return. So,
Right.
and if you get sick, you have $500,000. So I don't know a lot of strategy, a
That
GIC
could do that.
okay, I have a GIC 8%, and if I get sick, the GIC company, the bank will pay me $500,000. So it's really on the fixed income type of investment, but with a high rate of return because of the tax minimization.
Yeah.
And we have the benefit of, hey, if I'm that guy out of three that get cancer or a stroke or a heart attack, I receive $500,000, so it's a pretty good deal.
Right. Yeah. So there's almost like it's almost like an investment with a floor, right? So you've got a guaranteed rate of return as long as you continue to pay into it. You've
That's
got
it,
a
Andrew.
guaranteed rate of return. The only
Yeah.
real downside is if you go for 10 years and then you decide, you know what, I just don't have cash flow, something terrible happens to you and you can't afford to pay into it anymore, is really where the only risk is. Is that a safe assessment?
It's a safe assessment, but it never really happened to me that way because let's say you're a contractor and you paid it for 10 years and the contract term is 15, okay? And you say, I quit, I don't want to be a contractor anymore. And we didn't do a good plan, which we usually do. And in that case, the guy didn't follow the plan. There's no more money in the corporation, and it's either I forfeit my cash or what?
Yeah.
The or what is because it's a co-ownership agreement. And the first 10 years we paid it by the corporation. But do I want to forfeit $500,000 and I've been paying in the dark? I know. So what do I do? The last 5 years of the contract will be paid by the individual. So it would reduce the rate of return because instead of having the full term paid by the corporation, saving 2/3 of the tax, the last 5 years, I keep the contract and I pay it personally,
Right.
but at least I get a rate of return in that case that is maybe 5 to 7% instead of 8 to 12.
So
But
that's
we don't
that's
forfeit
flexible year
that
to
kind of
year, the percentage paid personally versus corp.
no. No,
No. Oh,
what the percentage paid by the corporation and the individual are fixed by the insurance companies. Okay,
right.
but let's say the guy at year 10 is about to cancel the policy because he doesn't want to be an independent contractor. He wants to close his company, and we have $500,000 invested in this contract that is his money due.
Right.
The last 5 years of a 15-year contract, we will keep paying it with personal money.
Right.
And we will receive personally all the money at the end. But it will reduce the rate of return because I didn't pay the full term with my corp. I paid 2/3 of the term with my corp and one third of the term with my personal cash. But
Right.
between forfeiting money and continue the strategy with personal dollar, we always recommend that you keep paying it.
You keep the policy.
Rarely do we plan so badly that the guy will have no money, to be honest with you, because this strategy, the way we structure it, after 3 to 5 years of consulting, we have enough money in the corp to keep the payment for the remaining term of the policy.
Gotcha.
Okay.
Now, another question for you, which is, again, specific to our client base. So our clients, it's not uncommon when they're starting out, they just have the one operating company, but as they begin to build wealth inside this corporation, that corporation will then convert to become the holding company, and they'll incorporate a new operating company. What would happen in a situation where they've done the critical illness inside of what was the operating company, but that becomes a holding company? Can it be transferred? Would it still trickle down to the operating company that it's now owned by this holding company?
Basically, as far as the critical illness strategy is concerned, because there's no cash value, okay, it's important, there's no cash value, it's portable. So
Right.
if the guy starts with an operating company and 5 years later he wants to create a holdco and he would like to move that contract and pay the contract by the holdco, no problem.
Excellent.
No problem. We just changed the co-owner. It was company X and him. Now it's company Z and him. No tax implication, nothing.
Excellent. And I think one of the other things that's really important to note is, like, this example that you put up on the screen earlier is just one example. Like, the whole point of this is that you are going to create a custom tailored plan for the individuals that you meet with. But,
Yeah.
the request people were giving us over and over again was like, hey, what does this actually mean in real world numbers?
Yeah.
So this is just one specific example where we just made up some fictional ages and amounts to show
Yeah.
people what an example would look like. But you would tailor this to the individual's needs.
Yeah, because keep in mind that if I meet a client that just started and I meet a client that's been a contractor for 10 years, even if the concept will be similar from one another, the amount of money that we may put in one strategy compared to the other will be different based on the amount of cash that we've accumulated in the company. The concept will remain the same, but it's tailored to the individual and to the corporation that we have in front of us. So depending on the cost of living, depending is the wife working, how much money do we need personally to accomplish what we want to accomplish, then the system will do his magic and say, this is the magic number that this guy is allowed to invest or should invest to maximize his plan or minimize his taxation. Okay. So we have some clients putting 10,000 a year, and we have some of your clients putting $100,000 a year in the same concept.
Yeah.
But they're two different independent contractors with two different scenarios. Okay.
Yeah. We do have another question, which I think is probably more for me, which they ask, I believe the insurance premiums are deductible for the corporation. Is that correct? And that's actually a great question to ask, because with critical illness, you do actually have the option of actually either deducting it or not deducting it. But in order for it to be tax-free, as we've discussed in this strategy here, you unfortunately aren't able to claim the premiums as a deductible business expense. So it's sort of one or the other. If you want it to be tax-free, which is a huge, big advantage, unfortunately, it's not the premiums themselves are not deductible. Now, again, one of the benefits that you do have, and this is a little bit hard to explain, hopefully I can make it hopefully it's clearer than mud. But the benefit that you do have with corporate insurance policies is they're paid with corporate tax dollars rather than personally tax dollars. Meaning that if you were to have a personal life insurance policy or personal critical illness policy, you would take the money out of your corporation, you would have to pay tax because you've withdrawn the money out of your corporation, and then pay for the insurance policy. Whereas if it's a corporate insurance policy, you're paying for it with retained earnings of the corporation. It's not a deductible business expense. It's actually what we call an add back. It shows up on your income statement, but it's added back on the tax return, so it's not deductible. But effectively what that means is you're paying for it with money that's been taxed at the corporate tax rate, which can be as low as 12.2% here in Ontario, versus the personal tax rate, which could be as high as 53.53%. So I don't
Good
know if
point.
you have anything you want to add to that, but hopefully that answers the question there on the deductibility of these expenses.
Yeah, we have no clients whatsoever that claim this as a deduction. You know, I mean,
No,
it's
and we
more
wouldn't
like seen as
recommend it. Yeah.
see it as an investment. If you invest on the stock market, you cannot invest pre-tax dollar. But here it's the same. You invest after tax dollar, but the money will have to come out one day.
Yep.
So the situation that you have to keep in mind is, do I want to pay tax today, tomorrow, or later at the full amount, or 2/3 is free and 1/3 I pay annually? Hey, do the math with whatever calculator you want to do, a good old Texas Instrument financial calculator, and you're going to see that it's going to be very tough to accomplish that kind of return guarantee. I'm sick or I'm healthy.
Yeah, and I think the whole point of this is, like, you do this for a living. You've looked at these, you're looking at the big picture holistic plan, and these are strategies that you guys have developed over decades that are specifically tailored towards our existing client base, which is IT consultants and service-based professionals.
That's it. You know, I mean, you cannot have a split dollar critical illness if you don't have a corporation. You know, it was designed for corporate people. So yes, a lot of IC didn't know about it because that's the way it is. But we've done a good job with you and a lot of other people working in the community to make this aware. You know, hey, buddy, this is out there. You know, it exists. You're not the guinea pig. You know, it's been going on for 25 years.
Yeah, absolutely. Now we have a flood of questions that have come through. I'm going to limit us to these questions before we move on, because we are about halfway through, and I want to be conscious of your schedule because I know you have a flight to catch. So I'll go through these questions and then maybe we can move on to the life insurance.
Life insurance,
yeah. So we got a question from Rob who says, typically, what is the lowest or average amount that is paid monthly to critical illness insurance policy? I will let you answer that, but I guess that really does depend on, like, what kind of benefit you're looking to receive. And that's the whole point of, like, meeting with you guys, is you'll create a tailored solution. There is no standard amount, is there?
No, there's no standard amount. You know, I mean, there will be a ceiling that is established by the insurance companies based on your age and your financial situation. So even if I want you to invest $100,000 in this contract because it makes sense, at the end of the day, you need to pass two tests, a health test and a financial test. So if you're not healthy, the insurance company may say, you know, $100,000, no, we're going to limit your investment at 50 grand. And looking at your finance, you know, I mean, no, we're going to propose $40,000. So basically, I always say, I ask for the maximum that makes sense for each individual. But after that, your health has to be checked and your financial situation has to be accounted for. Right. And then we start the plan with this. So I have, like I said, from 10 grand to 100 grand a year. Yeah. So it's very, very, very wide as far as scenario. Okay.
Yeah. And I think you kind of, in answering that question, kind of answered the other question, but I'll pose it anyways, just to make sure that the clients, and in case there's anything you want to add, but they said, what about age limits and medical questionnaires? And I guess you didn't say if there are any age limits to this.
Yeah. On this
but
one
obviously there is a medical questionnaire that goes along with this.
Yeah. So critical illness, the age maximum is 60 years old. Okay. Mm-hmm. So I even have a lot of clients pre-retirement that use this strategy to empty out the retained earnings tax efficiently because we evaluated that they have other money to live their early retirement years, and this is the best way to pull out the money. But if you're 60 years, 61 year, no, it doesn't work.
Exactly
L is not rocket science. If you add in the past a critical illness, you're already discarded.
Right.
Don't even think about it. But sometimes the husband is not LT, but the wife is LT, and we do strategy on husband and wife, and sometimes we've used also other member of the family,
like the children, or maybe the parents, not my parents, not in this situation, but
no, but younger parents, you know, I mean, yeah.
And so there's just one last question and a comment by someone on YouTube who says, thank you, this has been very helpful, which we always love to hear. But the last question around the critical illness is, in this specific scenario that you put up on the screen earlier, the 2475 amount, they want to clarify if that's paid by the shareholder. Which, if I recall from what was up on the screen, yes, it was.
Yeah, but it's not like it's paid. Okay, I want your client to understand that it's not that amount that has to be paid in tax. Andrew will account that amount as a taxable dividend.
Yeah.
So maybe on the example I showed you on the screen where you add a 2475, maybe the real tax out of your pocket that you will have to come up with to have that strategy live is maybe $7,000, $700, you know, not $7,000, but $700, you know.
Yeah, that's the portion that would be effectively the director's advance that would be either come out in the form of either a dividend or a salary. So I think the answer to your question fundamentally is yes. But again, that 32% and that 2475 amount is just an example. You'd want to look at you'd want to speak with Eric and do a specific run through of your financial situation to see what it would be in your situation, right?
Exactly. It will go from, let's say, what we've shown on the screen to a 50-50 split. If you're my age, let's say I'm 55 this year, so yeah, the older you
that
get,
32% is not a guaranteed what the split will be.
No. It was for a 39-year-old, but if you are 45, maybe it's going to be 45, sorry, 55, 45, something like that. Okay.
Yeah, absolutely. So should we jump into life insurance, or is there anything else that you'd like to add on the critical illness before we move over?
No, like critical illness, like I said, it's so simple when you understand how it works. You know, it's like boom, boom, boom. You know, it's either you're sick or not sick, and you're sick, you receive the money tax-free in the corp. You're not sick, you receive the money personally with no additional tax to be paid, which represent a very high rate of return because we mitigate the tax payment. So if I go on the life insurance side, I will share my screen with you now.
Sure.
So, okay. So you see my screen here?
It also has the potential to be a legit.
Yep.
You see my screen? Okay.
Yep.
I don't know if she's
So
seeing that, right?
life insurance can be structured where we can pay it more with more flexibility. Here, I showed a guy that's 59 and he will pay this amount for 5 years. We can pay it for 10 years. We can pay it for 7 years. We have way more option to structure a life insurance contract. Okay.
Right.
So keep in mind that flexibility on the life insurance side is an option. Flexibility on the critical side is not an option. But imagine this guy, so he invests from the corp 50 grand a year. We have two numbers that are very important in a life insurance. You mentioned earlier, Andrew, the cash value. Okay. And if you die, there's a death benefit. So imagine this guy. Okay. That's a real guy. Okay, so he was, or he still is 59 years old. You know, he will invest over the course of 5 years, $250,000. But we see that the cash value goes up in time, but he doesn't pay anymore here.
Right.
So you reach at year 6, your break-even level, and it keeps going up. keeps going up, keeps going up. Okay. So the way we use that money, okay,
Okay.
you either use life insurance as a retirement income, or you use that as a, I will pay the tax for my kids when I die. Okay, so I will explain both scenario, and 99.9% are an hybrid scenario. It's not
Yeah.
one or the other, it's one and the other. Okay.
Mhm.
So this guy, when we do the plan, you know, I mean, life insurance usually will be used as a retirement tool at the middle of your retirement for the remaining amount of your life. Okay. So for this guy, he will use other money that we plan with him, you know, at the beginning of his retirement. But the goal was to use that life insurance when he turns 75. Okay. So when he turned 75, he's invested $250,000. He stopped investing, and the value is 348. Okay. He goes to the bank and he says to the banker, how can I use that money? Eric will tell you how you can use that money. If you cancel the contract and you cancel everything, that amount of money will be taxable in the court because it will be seen as a regular investment on the stock market. So you will pay tax on the growth, and you must transfer the money in the form of a dividend. And it's not really the purpose of doing this strategy.
Yes.
This strategy is used to do exactly what I will tell you. We go to the bank and we say, hey, Mr. Banker, I have a contract here with $350,000, but if I'm dead, you receive $600,000. Are you willing to give me a loan on that amount, and you will pay yourself when I die?
Mhm.
So a loan is tax-free. So basically, this guy during his life will live with that $348,000 tax-free, and he will die one day. Let's say in that case, he dies 10 years later. The contract that they have with the lender will say the following. When you die, the banker will pay the loan back, charge the interest on that loan to the policy, and pay the remaining amount to the company.
Right.
What's great about the payment to the company, people will say, yeah, but if it goes to the company, then my succession will have to pay tax on it. No, that's the beauty of life insurance. The money will go into the company and bounce back by an account that we call in Andrew's jargon, a capital dividend account. So a capital dividend account, when it's paid from that account, which is created either by capital gain or by the proceed of a life insurance, goes to the beneficiary tax-free. So when we look at a structure like this, and if I had a guy much younger, you know, I mean, here I started with a guy that I didn't want to show you smoke and mirror on the screen, but if I start with a guy that's 40 years of age, it would be a lot sexier. You would see that, okay, Eric, let me explain. I invest $250,000. I use 348 tax-free, and my kids will end up with $300,000 tax-free at the end. If I do the rate of return on all those amounts of money tax-free, it's pretty steep rate of return. So we use this strategy to do two things, but you don't have to choose when we implement this strategy.
Hey, how you doing?
Every 40-year-old independent contractors I meet don't have a clue about succession planning, and they shouldn't. They're 40 years old. I just started to think about my succession planning. I'm 55. But usually when we start thinking about succession planning, it's already too late. We're already too old. So this strategy here, what the plan and the tool give us access to is we will implement this strategy where you don't have to decide at 40 years of age what you're going to do down the road. You can use it all for retirement, or you can use it all for succession planning, or a mix of both. And this is the beauty of this strategy. It grows with you, where you don't have to decide and play the crystal ball expert today.
accommodate
fuck, I don't know
later
me what
flights
I
later
want to do
starts.
in 20, 25
And
years from
we're
now.
putting agents
Here,
on
we have
individual
a
flights
solid
to
retirement
destinations
investment
versus the all
strategy.
flights.
And also when we realize down the road, you see, you have so much money, you don't really need your insurance policy to cover your cost of living at retirement. But you remember what I told you when we implement that when you were 40 years of age, you know, now when I do your plan, you have a tax bill to pay a debt of $500,000. Man,
Yeah.
would you like to have the insurance company payment to pay for that tax bill? Oh,
Yeah.
Eric, that's great. Yeah, I forgot about this. You know, that's exactly why life insurance
Not
structured
that
this
at all,
way
no. So we got like
is
all the people that are coming
very
from
powerful.
Alberta,
Okay.
Saskatchewan. and
Yeah, absolutely. And
Any
I'm
question?
well, there's quite a few questions that have come
Voodoo
through.
and keeping
I'll
them
come to those in just a second and just
buy them later
clarify
in
some
the
things
day,
and maybe
later
go
in
through
the
a few
morning,
questions of my
have
own
them
first, if
all
that's
later as
okay.
well to arrive
Yep.
on
You know, first of all, like I couldn't agree with you more. This is an
No,
undervalued
they're not missing the
tool
first day. They would just be
because of
arriving a little bit
the
later in
capital
day than
dividend.
initially
So,
expected.
like, yes, there is a cash surrender value, which is I kind of think of like it's your emergency parachute if both engines on the plane go out and there's something terrible that has happened and you need to get out, but it's a worst case scenario that
Yeah,
you're
so the
using the
secondary
cash
question on
surrender
that would
value.
be, all
That
right,
you're
if it
taking
makes
out the cash
sense,
surrender value and you're
does it
stopping
make
paying into
more
the
sense for
policy.
you guys?
Yeah.
The goal is to pay into
just
the
have
policy
them
all the way until
arrive,
death,
maybe not first thing in
and
the
that
morning, but a little bit
you
later
will
in the
get
day.
into the corporation a benefit that will go into the capital dividend account and that can flow to the estate
Yeah.
or the shareholders of the corporation tax-free. And then the big benefit is because they'll take out that dividend tax-free, the retained earnings are decreased, hopefully maybe down to zero, so that there's no estate tax on the value of the corporation. So you're effectively getting all of the retained earnings of your corporation out to your children completely tax-free. And if you do need, because there is that situation, people are like, well,
No.
I don't know, I might need some of the value of the retained earnings in the corporation for my own retirement, because I don't
Yep.
know how long I'm going to live. I don't know what kind of lifestyle I'm
Yep.
going to want to
I
have.
don't know that we
Well, the
need
benefit is
to-
you can still borrow against that cash surrender value and use up some of that benefit. And
Yep.
will still come out
No,
to you
it's not all of
tax-free. You
them.
might pay some interest
but we've got
on, you know,
the
what you're
itinerary
borrowing from the bank,
frequency,
but the bank
right?
is
It's-
using the
everybody's
cash
coming
surrender
from
value and the
Western
benefit
Canada, and that was covered,
as
and
the
BC,
collateral for the
Saskatchewan.
loan that they'll lend you. And again, loans are
so-
tax-free. They're not taxable income to you. So you're getting all this money out that you're using in a very, very tax efficient
way.
way.
Yeah.
Yeah.
Yeah, I
And now some of the
it's
questions that have come through,
that's what it has to be,
some of them do relate back to the critical illness. I'll try to avoid those ones, but this one is sort of for both. Does it work in Quebec? Again, I know the answer to that because you're based out of Quebec.
Yeah.
I don't know all the
It works
But-
everywhere
Yeah.
in Canada. You know, I mean, basically in Quebec, we have information bulletin from Revenu Quebec, and in the rest of Canada, we have information bulletin from CRA, and both level of government, you know, basically guide the tax expert in that field on how to do it to pass the test of CRA or Revenu Quebec. Because a lot of people are telling me, oh my God, my accountant told me that it was not true, you know, and well, basically, if you do the tax treatment the way I say to do it, based on the information bulletin from both level of government, you're okay. But imagine a guy that is not me, and he works with an insurance company, and the split dollar, instead of being 35-65, is 5% as a dividend taxable in the hands of the person, and 95% of the amount paid is by the corporation. You take a good strategy that is approved by CRA, make it a ticking bomb for a client that will be denied at the end. Is it because the strategy is no good? No, it's because the guy pushed the envelope so
Thanks,
bad
thanks. And if anything, we can
that
get on
now
with
we
Jack
don't
later
have that
in
line in the sand that the insurance
I do need to
companies
look right
draw. We
Okay,
played
all right.
with
All right,
the
bye.
product and tweak it to make it more sexy in a sales pitch to the client, but it's a recipe for disaster. So I've seen contracts out there where, by the way, hey, mine is a lot better. My company pays 95% of the premium, and me, I only have to pay a little 5%. Yeah, it's very good in a living room when the auditor knocks on the door, you know, good luck for the escape goat, because you're going to be in deep trouble. So if you follow and work with people that are legitimate and they
Yeah.
do that day in and day out, you know, I mean, this is what we do, but we will explain to you the good, the bad, the ugly. And that's what we've been doing for 15 years. Okay.
Yeah, and you guys don't push the envelope. You're relatively conservative.
Yeah.
I would say, and because we have worked with some other people who there's something that we call the ICE maneuver, which is a far more aggressive strategy that involves again, similar strategy where you're boring against um the cash surrender value, but it's a little bit more complicated and a little bit more risky, which is not something that you guys do.
But I want to add something, Andrew, for all the clients or the people online, you know, that are diehard real estate investors. You know, I will bring back the screen, and I told you at the beginning, this strategy using life insurance is very flexible. So imagine that guy, okay? Same guy, but he says, and he's not 59, let's agree he's 40. And he says, Eric, can I borrow at year 6 $250,000, invest in a down payment real estate, do some fixing, increase the rent, refinance, take the equity, and pay back that loan 3 years from now, and keep doing this along the way? Yes. So I explain it to you as a retirement plan and a succession plan, but the cash value here can be accessed in the form of a loan anytime along the way.
Yeah.
So we have a lot of real estate independent contractors that, Eric, I like your strategy, but it ties my cash. I need the cash to buy real estate. But
Right.
this is a very good strategy where you have your cake and eat it too. You have your life insurance, you have your retirement plan, you have your leverage to be your own banker instead of going to private lender to finish the financial montage, let's say, of your deal. It's very powerful. But every case is different, you know. I mean, just keep in mind that depending on what you want to do, what you want to accomplish, life insurance has a lot more weapons that you may think about.
Yeah.
And critical illness is more like a bank shot, you know, bang, bang. That's it. Very easy to understand. There is no option. It's boom, boom.
Yeah, it's really there to protect against the risk that something were to happen to you, whereas the life insurance policy is more it's a tax strategy, right? Designed to help you transfer assets at death tax efficiently, right?
But the critical
access to-
illness, the critical illness is also a tax strategy and very powerful investment, but it's easier to understand because you don't have 5 different options.
yeah,
It's one option.
it's
You're
not quite
sick
as
or
variable.
you're healthy. Yeah, the life insurance, as many of our, Eric, can I do this? Yes. Eric, can I do that? Yes. With
Yeah.
critical illness, it's very
No.
powerful, but it's this or that. Boom,
Yeah.
boom.
Yeah, and that's the one thing, is that's why it's so critical to have a conversation with you, because it's infinitely flexible, and it's flexible from year to year, right? Like you can be
Yeah.
like, I want to put 50,000 in this year, 100,000 in the next year. You can change it year to year, correct? With the
Yeah, if we structure it properly, you know, I
Yeah.
mean, you have very fixed term also like critical illness, but if you want some flexibility, we can go with different insurer that will give you that flexibility. So depending again on who's in front of me, life insurance can be designed in such a way that the same amount has to be put every year, or a different amount can be put every year depending on your cash flow and availability of money. Okay.
Yeah. And I know we've only got a few minutes left, but should we, is it worthwhile explaining the difference between term and whole life insurance for those who may not be familiar with the concepts?
Yes, but before, after, I really want to show you a plan and the way we summarize the plan in a one-pager for the benefit of your viewers. Okay.
Yeah,
So
let's do that.
term insurance, it says it's for a short period of time. So let's say you just got married, you have kids, you don't have a lot of cash, but you know that if you die prematurely, your family will be in trouble. So you want to cover the mortgage, you want to cover the replacement of your salary. So you take a very cheap $2 million term policy for 20 years and you pay $75 a month, and if you die, your family gets the money. And if you don't die, you paid for nothing. Pure insurance. I pay, I'm not sick, I'm not dead, I paid in the dark. But at the beginning of a career, it's important. So what we do is we work with insurance companies, Andrew, that all have the transformation option. You start with term insurance, and along the way, when you have more cash, we convert all or a portion of that term insurance into an investment life insurance.
Right.
Because we work with convertible term life insurance to investment insurance. Okay.
Yeah, you should never have term insurance that's not convertible. And generally speaking, I'm not personally a fan. I see your point that there is a place for it for you at your earlier careers, but usually when I'm talking with clients and I'm talking about net worth planning and estate planning, we're really talking whole life policies here as the primary tool and strategy. And I think the one thing is you got to be really careful that if someone is pitching you a term life, which are generally cheaper than the whole life policies, that it is a convertible policy. And because like a non-convertible policy to me is a complete, maybe not a complete waste, but it's not something I would recommend.
Yeah. And it has to be convertible, but convertible into a good participative life insurance. Okay. Conversion is everywhere, but for me, converting to what? Converting to a product that is very powerful to do exactly what I talked to you about. Okay. So conversion, but convert in what? The caterpillar, I want a butterfly. I don't want something else. So I want a proper structure to convert into a good policy that's an investment. So let me share one more screen. You will see not a lot of things on that screen. That's the sad part. But if some of you want to see it, you can write down and we will share with you. Okay. So hold on one second.
That up, Eric, for people who do have questions, and I know we've only got a few minutes left.
Yeah.
And you've got a flight to catch. What's the best way for people to reach out and connect with you and your team if they'd like to learn more?
Basically, they can write directly to me, at e.chevrette. I know it's tough. It's CHEVRETTE at finances, in plural, finance with an S at the end, TI360.com. So e.chevrette at financesti360.com. So let me share, and I can stay another 5 minutes, so that's not a problem, Andrew.
Yeah.
So
we're looking at your Bluetooth peripheral, so I'm not sure if you're sharing the right screen.
I know. Okay, now I'm good. Okay, do you see my screen now?
It's coming up. Yeah, now a cash out close. Yeah.
Okay, so basically, we produce a 39-page document where you have the reference scenario, and every year it will tell the client what to do during the accumulation phase and what to do during the retirement phase, because we go all the way from year 46 in that case, and we end up at 95. Okay. And
Mhm.
what's important to see is this, Andrew, okay? So do you see my screen on the top? Hold on 1 second. Okay, so you have while you're living and you have when you're dead, okay?
Right.
So what do I want? I want a scenario that is the reference scenario. It's what you do today without our planning tool. You have your gross while you're living and gross or net after you're dead. But what I want to compare it to is the optimized scenario. And what I want to see is the added value of my expertise. So you can see yearly what we have to do and what it will represent while you're living and after your death. And after that, we will give you a report that looks like this. Hold on 1 second. I'm almost done. And after, you can ask all the question away. That will be a lot of fun. You see my screen?
Yep.
Okay. So here we have Jack on track, basically he wants to retire at 65, and we have the current estate value or the current scenario compared to the IT recommendation. We have the insurance strategy that in the case of this client wanted to bonify his estate. We add $3 million on his estate because of the insurance strategies.
Mhm.
And the other two strategies we'll talk in a later session.
Other
It's
sessions, yeah.
how to create a pension plan and how to use corporate class funds in your corporation. But you see that all layers add value, and this guy was not in trouble, with or without me. He was in a very good state,
Mhm.
financial state, but he likes me more because I can bonify his plan by 36%. Okay.
Right.
So all the tools that I showed you is exactly what your people or the people working with us will see. The same type of format, the same type of tool to see the reference scenario compared to the optimized scenario. And do you want to add value to your retirement, or I want to add value to my estate? Everybody's different, but they all have the same goal. Accumulate money, pay less tax.
Yeah. And what I do want to share with everyone too is that Eric has graciously committed to 6 webinars over the course of the year. So we're going to be coming back and we're going to be looking at, because there's a whole bunch of things that you can do with IT360, not just insurance products. And so we're going to be looking at different tools in these various webinars, as well as he's graciously offered to bring an economist from Desjardins in twice a year, who's going to be coming in to share states of the economy with us. So, make sure to check out our website, cpa4it.ca /events, to see what we've got scheduled for the upcoming year. And, again, if you want to book some time with Eric, you can reach out to Eric directly. If you forget his email for whatever reason and you're a client, reach out to your account manager. We'll obviously connect you with Eric, as he is, a partner of IT360.
You can definitely find me on internet, IT360 Financial, if you just do a little research, you will find me definitely.
Yeah. And we do have a couple of questions. I don't know if you have time, because I know we are past time. Do you mind if we hit a couple of questions?
Yeah, I'm good. Let's say give ourselves another 9 minutes, okay?
Yeah.
At 40,
okay.
at 40, I have to go because they're probably starting to board. The flight depart at 2:10. So
yes,
shoot.
I got to make sure I can do it for another 10, because I do have another client meeting coming up myself. I have a meeting at 1:45, so I can do for another 10.
Okay, let's go.
So first question here is, if over 60 years old, can I still leverage the life insurance strategy?
Yes. Critical illness stop at 60. Life insurance don't stop.
Yeah.
As long as you're insurable. Okay.
Another one sort of related. I understand that life insurance is only available to individuals or shareholders under 60 years old, and it's not a taxable benefit. Again, some misunderstanding there. I think that's some misinterpretation between the critical
illness and the life insurance, So I know it's a lot of information in one session. So in doubt, just check, circle back to Andrew's team or to me or one of my team members, because I don't want you to go with the wrong information.
Yeah. And again, maybe this is the time we can answer that question that came in very first, which is, does the beneficiary of the life insurance payout need to own shares in the corporation? It's the corporation that's the beneficiary. That's then paid out through the capital dividend account to shareholders of the corporation. So the people who will receive the funds in the end are the shareholders of the corporation. And that's specific. Like, it's not to say that there aren't life insurance policies where you can be the personal beneficiary. What we're talking about here, these specific tax maneuvers and tax strategies, it is the corporation that is the.
But I want to bring a little nuance to what you said, Andrew, is when the corporation takes the life insurance, for instance, and you die, the money goes in the CDA account, and it will not be paid to shareholder per se. It will be paid to the succession tax-free.
Yeah. Well,
Okay.
yeah. Yes. Effectively,
Okay.
it's coming out tax-free, which is the most important thing.
Exactly.
Will questions and answers be emailed or available to be sent after? We're not going to send them out after. They will be. This is all streamed live on our social media channels. You can go back and watch on the social media channels. In addition, we normally take clips out of this, and so probably some of those are going to be questions based off of some AI that's going to pull out some short snippets that'll be available on our social media channels as well. But we won't be answering or sending out specifically the Q&A. Although I'll pose that to my marketing team as to whether they think that might be beneficial. So I'd say normally don't hold your breath. You'll need to come back and watch those, but it's a definite maybe. And then the last question that we've got here is, to my understanding, term insurance do not have cash surrender value.
You're right.
Annual cash dividend is not guaranteed. Is the dividend cash on the insurance companies? Is the dividend based on the insurance company's performance? I'm not sure I fully understand this question.
No, but I think I understand. I mean, first, you're right. Term insurance don't have cash value, but when you have, let's say, a whole life with participation that is designed to grow the estate of a person or the cash surrender value of an individual, you have a guaranteed portion and you have a variable portion. Right. When we submit illustrations, they're based on long history. Does it mean that the scenario we're illustrating will materialize exactly like it is? Never. Does it mean that we'll be very out of whack? No, because the way that they distribute for the past 50 years on those products are very consistent. Yeah, there's a variation, and if I say it's going to be 200,000, it's not going to be 400, but it's not going to be 50. Maybe it's going to be 225 or it's going to be 178. But it's in line with what we're presenting, so it's not guaranteed, but it's pretty close.
Yeah, because it's an investment that can go up or down. They usually have a ceiling, so they can't go down significantly, but you have to understand that it is an investment. They do get annual statements that explain how it's done, what the current cash surrender value is every year. So you can see the results. But I think the misconception, and I think back to, we used to have an accountant that we worked with who's a financial advisor now, and who was not as interested in the insurance strategy because he was looking narrow-mindedly at the returns. It's not about the returns of the investment that are driving the value of life insurance policy, because they're normally very conservative so that there's not these wild fluctuations. They're not very aggressive.
It's the tax implication of the end game.
Yes. That is really the real reason that you're looking at this. Not like, this is not you're going to get rich on the investment. You're also not going to get broke on it either. You're looking at this as a tool for moving equity out of your corporation to your estate tax effectively.
Making decent returns, though. Don't get me wrong, though. Okay, making very, very, very decent return after tax. So
Yeah.
basically, we decided a long time ago, sorry for my English, but to escape that pissing contest game of rate of return,
Yeah.
for us, rate of return, yes, but after tax. So
Yeah.
what is the real dollar that you have in your pocket to spend? Because the rest doesn't interest me because, oh yeah, you had a 20% rate of return in your corporation, tax at 50%, and the money is still in the corp and you need to pay yourself a dividend. So maybe it's only a 6% net. For me, when you meet with us, you will realize that this is the net rate of return, the money after all the gates of taxes that is in your pocket that interests me, because that's how you're going to pay your bills and your retirement, not with the pre-tax dollar in a corporate.
Yeah, I couldn't agree more. And on
So-
that, we've got we're pretty much at time. So I
Yeah,
want to just take this opportunity again to thank you.
thank you.
Give you one more opportunity to share that email address for anyone who didn't get it earlier.
So
And,
if you want to
give you
reach
time to
us,
go catch your flight.
thank you so much. So it's e.chevrette, Chevrette at finances, TI360.com. So on that,
Awesome.
I have to let you go if I don't want to walk to Toronto.
Yes, go catch your flight. Thank you very much for your time. And come to everyone else who's live with us on either social media or in Zoom. Go check cpa4it.ca/events to see the next time we're going to have Eric back. And thank you, everyone, and bye for now.